when you look at my screen and you see cocoa and orange juice and copper and, treasury bonds and soybean futures, what I'm trying
Hmm.
to do is to get away from any correlation in the stock market where you have a whole bunch of technology stocks doing one thing or a whole bunch of industrials doing another thing. And because, let's face it, if you're looking at the soybean market, the Australian dollar really doesn't care.
Right.
And if you're looking at the gold market against, say, um, the orange juice market, the orange juice market doesn't care what gold's doing today.
Hmm. Hmm.
So you've
Yeah.
got just logically true diversification. And when you're a smaller investor, and I would rate myself a smaller investor. I'm retired now. I'm not managing 600 million in 1997 like I was with Trendstat, which would be almost a billion or more today, probably. That was hard work, but if you're just managing an individual portfolio, you can get in and out of an orange juice market that trades a few hundred contracts a day real easily. It's not like you're going to get killed doing it. But if I was back at the $600 million days, I would have had to, buy the entire day's trading volume. Well, I'm not going to trade that market.
Yeah. Right.
So there's all sorts of things that the big guys do that ends up making them very correlated and very exposed to that risk. And it's actually an edge that a lot of small traders don't realize they have. They can get into issues. I mean, some traders, professional traders running institutional accounts have to buy stocks that are over $10 a share.
Hmm.
They have it written in their charter. They have to have a $10 share or they can't buy the stock. If you were to buy something that was $9.75 and it happened to become 10 and everybody started jumping on, you could have a big winner there. So you can do things as a small investor that the big guy can't do. And there's lots of little examples that volume there you could get in on stocks that have a little bit smaller volume where Vanguard or somebody needs to come in and they need to buy millions and millions and, tens of millions basically of a position. You don't need to worry about that. You can have them come in and buy your shares at a very advanced price and sell it to them and go out and look for another one. And so smaller investors have some advantages if they'll think about it a little bit and take advantage of some of those edges.
No, absolutely. I mean, again, even even building into a position like, how an institution might build a 1% position, even in a fairly liquid stock, they have to kind of do it over time if they've got a sizable, sizable, assets under management that they're dealing with. So yeah, I used to always say we're, individual investors, we're the speedboats out in the water. We have to watch out for those big oil tankers. You don't want to go against one of those, but you can certainly react faster and do a lot more in terms of your
Exactly.
mobility. I want
And
to
I
talk a little
do.
bit. Yeah, right, exactly. I want to talk a little bit about because you brought up gold and how that might not have anything to do with the orange juice and so on. Um, let's talk a little bit about maybe the macro side of things because certainly people can look at, oh, well, usually gold does something, it's kind of does better in markets where there's fear, right? Or inflation fears and all these things. And usually it's not going to be outperforming when growth is doing real well. And I think one of the things that kind of had some people scratching their heads is that you had, the AI and the tech stocks doing so well, and you had gold also doing well. And, sometimes it's kind of hard to come up with the story of why. And a lot of times people want that why. Oh, why is this happening? Why is the norm not happening? Even in the seasonality, like, a lot of people were pointing to, well, gosh, in summertime, usually not much happens, but this was a great summer. If you had just decided, oh, I'm going to take the summer off because that's usually a poor time in the market, you missed out on some great a great trending market. So I guess, with all of these other factors, seasonality, typical correlations of things, how does that factor into your decision making?
I don't use seasonality at all because my attitude, or one of the sayings I keep saying over and over again, and not only myself, but others, would be the market will do whatever the market wants to do. The market will do what the market will do. And so when I try to come in the morning or approach trading, I try to not have any predictive bias in terms of I think it's going to be up or I think it's going to be down or think it's going to go sideways today. I might have a suspicion that it might, but it doesn't affect what I trade. And so I'm just running these strategies, and the strategies have already thought through some of those types of conditions. In the case of gold, if you think about it, gold doesn't have a huge amount of actual value or industrial purpose. It basically sells and buys to each other whatever it wants to buy or sell at. And I think that um, means that it could have very strong moves that would scratch your head. And there's other moves that might be tied to panics or financial crises or whatever. And the market will do whatever the market will do. This is an example of where gold decided it was on an upswing and the trends took over. And, that would be, it was a good run. And I think that the down move could be the unwinding of some of that, the taking profits and all that. It might have nothing to do with economics, might have nothing to do with inflation, might have nothing to do with the dollar. It might just be people seeing gold's making a good run. They see the advertising on television, they want to get in.
Well, and you brought up industrial uses. I mean, a lot of people do point to silver, or platinum. You know, platinum is of course used for the catalytic converters, and everything. But these were kind of having some strong moves too. I mean, platinum. Geez, I didn't even realize this. It was up 5.8 today. Um, so again, okay, now we're talking about something with an industrial use, not just a shiny
Mhm.
metal.
Yeah.
Does that kind of change your analysis, or not
I
really?
I'm not a fundamentalist, so I'm looking at that chart and I ended up short platinum, just a minor amount because the volatility is so great. So kind of a minimum position. And who knows whether it's going to carry or not. I had a down day today because I'm short and the market was up. So in platinum.
Hmm.
And so I think the lesson to be learned is try not to have a huge amount of bias, but try to look at what is happening in the now. I think too many traders try to think about last week or next week and they agonize over the profits that they missed, the losses they took. And they worry about, well, what's the Fed gonna do next week, and what's the market gonna is it gonna continue to have a good economy? What is the administration gonna come out with new policies that's gonna affect the stock market? They agonize over all of that stuff, and if you're managing $1 billion, you probably need to agonize a little bit because you gotta get in over the course of days. But for a small trader, you got an edge. You just look at it and say, "Okay, it's breaking out of the Dodge to the upside, I'm going long." Why? I don't know why. I'm just because it's breaking the Dachshund. And keep it simple. Take your signal, act on it right away, or have a stop by sitting there, and you're executed and you're off to the races, and you don't have to worry about why. Just let it keep running, and as long as it keeps running, you'd keep enjoying the ride.